Howdy, Team 42. It's your skipper here, Darius Dell, to present another exciting episode of Pro to Pro Live. I'm joined with David Hunter, our friend David Hunter, Chief Macro Strategist at Contrarian Macro Advisors. How you doing today, David?
Darius, how are you?
I'm doing very well, my friend. You've been quite the bull voice for the past year and a half or so, and I just want to congratulate you on that very good market call. Before we even get into your research and your thematic views, I'd love to hear some more about what your career and what you guys are doing for your clients over at Contrarian Macro Advisors.
Sure. I've been on the street for 50 years, or been in business for 50 years. First half of my career was as a money manager. I managed pension monies at one point, in-house for Textron back in the 80s. Went from there to Fidelity, managing overseas accounts with U.S. portfolios, and was head of active equity at ITT Hartford, now Hartford Insurance Group, for several years, and chief investment officer at one point for a $1 billion money management firm in New York. And then I transitioned over to macro strategy and have been a macro strategist for the last probably 25 years. And basically now I'm semi-retired, so Contrarian Macro Advisors is just me, basically.
I love it. Well, I love it, man. I appreciate it, man. So you've had a dearth of experience, or a wealth of experience, rather, on Global Wall Street. And one of my favorite things to do as a sort of younger investor, at least on the younger end of that spectrum, is to listen to and glean insights from folks with gray hair. I think, in my opinion, I think you need gray hair and gray beards, and I'm starting to get a few of them. That's why I keep my size short. I think you need gray hair to be good at this game, man. This is a game that, as much as it is technical, it's emotional, it's behavioral, and ultimately it requires a lot of orthogonal skill sets to be good at on a consistent basis. So I just want to say thank you for your time and looking forward to this conversation.
Sure, I certainly agree. I came into the business in '73, so I saw the Nifty 50 and then saw the other side of the Nifty 50. So it kind of led me very quickly to the understanding of managing risk and capital preservation. And then each cycle, you kind of see different things and learn different things. So, to me, there's no substitute for experience.
Agreed. So, actually, before we even get into, it's such a great opportunity to connect with you. Before we even get into your current themes, I'd love to sort of get a sense of your investment process. So, what is it that you're focused on when you're trying to manage risk in financial markets? What sort of indicators or sort of themes that you tend to try to focus on more than most? Kind of give me a little bit of background there.
Yeah, as a contrarian strategist, macro strategist, I'm pretty top-down oriented. And as I say, I look at fundamentals, I look at technicals. I certainly spend a lot of time with macro, and also cross markets. So if I can get various markets to confirm what I'm seeing, or what I'm kind of reaching as conclusions that just increase the convictions for me, and then I put all that together and look at it in the context of sentiment. So, as I say, at tops and bottoms, I'm pretty comfortable being all by myself, or pretty close to all by myself in views. That tends to be when I do best. As you get into a move, as we're seeing here, the move from 2022 up till now, took a long while for people to overcome their bearishness, their skepticism. But you're seeing now more and more moving over to the bullish side. And I get on Twitter every day, aren't you getting nervous that people are agreeing with your view now? And I go, no, there's a big middle part of the move where the consensus is right. So I'm, yes, I'm contrarian, but I'm very comfortably in consensus when you're kind of in the meat of the move.
Oh, I love that. So that drills right down into it. So the meat of the move is a hot take at this point from the perspective of some investors. So just walk us through your sort of broader 30,000-foot view on asset markets, and then we can kind of drill down from there.
Sure. Yeah, I mean, I am probably still the most bullish strategist out on the street. I have a target for the S&P of 7,000, 23,000 for the NASDAQ, 55,000 for the Dow, and 3,300 for the Russell. And increased those numbers to those targets back in my January letter. They're crazy numbers, I know. They looked even crazier, even my old targets, back 6 months ago. But I really do think we're in a end of secular bull market period. So what I think is a 41 going on 42-year secular bull market that started in August of '82. I was managing money for Textron back then, and I distinctly remember, because we put our money in right at the bottom. They had been very anti-equity, and I was brought in to start building an equity portfolio. And it was, I came in December, said keep your powder dry, and in August we started committed capital. And from that, I think we've had this long secular bull with obviously several cyclical bull and bears along the way. But I think we're in the last innings of that, and I think we're probably going to see that top this year, and probably sooner rather than later, meaning maybe this summer. Doesn't have to top out that fast, but you look at the targets I have, and a comment like that, and it sounds impossible that you can make those kind of moves. But I think we're into that parabolic phase. As I say, the bull leg started back in October 2022 at the 3,500 level. I think we started the melt-up phase back in October 2023. It's been moving up pretty steeply since, and I think we just steepen from here into the top. You're gonna go parabolic here, I think, in the next month.
Interesting. So if you let's sort of do an anatomy of this move, right? So we're sort of in the middle of the move. We're kind of entering, or maybe in the early innings of the parabolic part of the move. What's in your opinion, what has been driving the move off the October lows to now, and what's likely to cause it to go parabolic if we are starting to that point in the process?
Yeah, so much of it is really the sentiment. One of the things that got me so bullish 2 years ago was that, or a year and a half ago, was that you had just a consensus, a broad consensus of negative. Everybody was looking for lower. Everybody had the reasons why this thing was going to be in very rough shape for a long time. And there was just such unanimous opinion on that as I said, I felt as a contrarian, sentiment was about as negative as it gets. So that was, for the turn, that helped drive it. And since then, my observation was that we've had skepticism all the way up, a very healthy level of skepticism, what I call the wall of worry, stayed intact. Every time you had a move, any small step back, you saw the bears come right back out of hiding. Oh, yeah. And I think you still see that. Yes, we've, once we broke into new high territory, and somewhere above 4,800, say towards 5,000, you saw a lot more people beginning to abandon their bearishness and say, yeah, I have to respect the fact that this is new highs and we're in a bull market. But if you look below the surface, as I say, most of those new bulls, it was bullish without conviction. They were up there because the tape was up there, but they really, as soon as the tape, you get a day like this, and they start talking negative again. Maybe not back down to the bottom, but certainly, that they're looking for a much better entry point than they've seen to date.
Yeah, 100%. Colin, if you could throw up the slide 22 from our today's lead-off morning note on the screen, where we show our positioning model, and we sort of divide our analysis of sentiment and positioning into sort of two different distinctions. On the left half of the chart, we have all the sort of tactical sentiment indicators that will give you an indication of where the market can go over the kind of a multi-week period. On the right side of the chart, we have our more sticky and stable sentiment indicators that have a lot more sort of clairvoyance into a multi-month time horizon. And what we see is if when we aggregate U.S. equities positioning across all the factors that the CFTC keeps track of, when you look at that on a non-commercial net length divided by total open interest perspective, we are still only in the 33rd percentile of historical readings, with that time series going all the way back to mid-90s. On a median basis, we're typically in the 60th percentile. On a median basis in that statistic, we're typically in the 62nd percentile at these major bull market peaks. And by the way, that 33rd percentile is roughly in the 100th percentile of the last year or so, which means we've seen investors kicking and investors have been dragged into this bull market, kicking and dragging and screaming the entire time, and we have still not seen that sort of structural upside capitulation that you typically observe at major bull market peaks. So we're right there with you that some of these longer term sentiment indicators that might suggest that there is upside risk in this market here, even if the shorter term indicators are suggesting that the correction is likely underway.
Yeah, my sense, look, this pretty much looks totally in agreement with what I'm saying. So, and what I think you could see here, if this thing, whether it this pullback lasts a few days or turns quickly, I think you're going to see the next move up. Many of those that started getting mentally prepared for a bull market but not ready to commit, looking for a better entry point, may finally say, hey, we got to chase, we can't stay here. We may not, these pullbacks are short, they may be sharp, but they don't last long. And I think you are setting up here in this quarter for some sort of a buying stampede where you've got an awful lot of that money that was skeptical and on the sidelines coming in all in a concentrated period of time. And it doesn't look like it based on the CPI today, but I suspect part of what will get them more comfortable will be, some settling down in terms of this concern that inflation is breaking out and, the economy is too strong for the Fed to cut. I think, fast forward a few weeks and we may have a different opinion out there.
100%. So I like how you sort of think about this from a multi-duration perspective as well. I think all great investors understand how to think about risk from a time horizon perspective and also from a multi-factor perspective in terms of what's driving markets, but also the kinds of risks you're taking in your portfolio. You want to construct a series of orthogonal bets, obviously, if you're trying to diversify correctly. You said something that I think definitely bears unpacking. It's not that I don't disagree. It's not that I disagree, but I think our audience would certainly appreciate if you unpacked how you get to 7,000. I think we're somewhere around 5,150 on the S&P 5 right now. How do we get from here to 7,000? Because that's obviously quite a ways away.
Yeah, I don't have any magic model that gets me there. It's really just looking at it and saying you've still got an awful lot of money on the sidelines or people allocated more defensively, and I think that's about to change. I think we are in a market that can become very illiquid in a hurry. It was illiquid on the way down. On our way down to 3,500, it'll get even more illiquid as more people move from one side to the other. And I think in that late stage, I'm just, again, we'll see whether it proves right or not, but I think you could have a situation where I use NVIDIA as a good kind of picture of what I think we could see on a market-wide basis, where you could see all of a sudden, 1,000 points in a month. So, you climb from, 4,800 to 6,000 over the course of, 4, 5, 6 months. And then you climb the last 1,000 in the course of a couple months. So I just think it's that steepening of the curve, and it's because you get so many people who are fighting this for so long coming in at the same time, and again, not many people selling.
Gotcha. I like that. So I'm put my devil's advocate hat on here because we're definitely still in the bull camp. But I do have to call this out because it's certainly something that we've done some research on. Colin, if you throw slide 89 from last Friday's macro scouting report on the tape here, we are currently at over 6 trillion in cash and money market funds. And when we went back and studied this sort of sequence of money market funds, particularly when they leave the sideline, when that cash leaves the sideline, it typically only does so after you've seen rate cuts and a market crash, and that's historically consistent with the last 3 cycles, or at least the cycles that we've observed with respect to that money market fund data being in existence. So, what say you to that? Sort of devil's advocate pushback.
Yeah, I just sense, and again, this one's going to be the top of all tops. Psychology is such, investor psychology is such. I still believe. I'm not at all counting on 4 or 5 trillion or 6 trillion money market funds to be committed to the stock market. That's not what that money is.
Mhm.
But I could see a third of that going back in, so a couple trillion of it. And just like we saw at the bottom, everybody was bearish and raising cash. I think at the top you're going to see, and I've warned people on Twitter many times in the last 6 months or more, that when you get to the top, it's not going to be an easy sell. You're going to have compelling reasons why, and the street telling you why this thing has legs and why it's not a short-term thing, and you're gonna buy into that because that's just psychology. Is at the top everybody's bullish, at the bottom everybody's bearish. So I would argue that you will see a chunk of that cash committed, and certainly hedge funds, which are not really part of that, or institutions that are more defensively postured. I think all of that's going to play in here in the spring into the summer. And in terms of the Fed and interest rate cuts, I know the chart that went around and so many people bought into that says, as soon as the Fed starts cutting, you want to head for the hills. If we have, for several more months, a case where the economy looks, like soft landing or no landing is the case, and the Fed's cutting because they realize, real rates are just too restrictive, or there is under the surface more weakness that or loan demand is very weak, as we're seeing, the banks are struggling. If they're cutting for those reasons rather than the economy, heading for recession, or at least the perception that the economy is not heading for recession, then I think rate cuts are not a negative. They will be at some point, but I don't think they will be initially. So my case does not rest on whether the Fed cuts or not. I spend very little time worrying about how many cuts we're going to have this year, or whether they're going to cut or not. As I say, the bond market will lead the Fed, and I still believe what we're going to see here is that the 5% last October on the 10-year was the high. We've consolidated the 120 basis point move down here, and I think rates will roll over here soon, head to lower lows, head towards 3%. So if I'm right, I think you're going to have a backdrop of lower rates, at least from the bond market, and probably the Fed joining it at some point, and probably a weaker dollar, and an economy that looks like it's kind of the porridge is just right.
No, I love that. I love that. You said a few things that I think are worthy of unpacking. One, I just want to congratulate you for not playing the parlor game. That is, how many cuts is the Fed going to cut in this particular calendar year, or when does the Fed? When are they going to start cutting? I mean, in my opinion, that's save that for financial media TV. Us investors, we have a totally different job to do, and in our opinion, it's managing risk. One of the I guess key elements of your research view is that you're going to have a better outcomes in the bond market than we've recently experienced. What do you say if I told you that a no landing scenario was the highest probability outcome? Let's assume that is the most likely outcome. Colin, if you could throw that slide 79 here on the tape here, where we show our forecast for growth. We're looking like a no landing scenario relative to the soft landing that consensus currently has baked into the case from a growth perspective. And then we're looking at a no landing in inflation, particularly relative to the longer term time series. If that is the outcome, particularly over the next 12-month time horizon, do you see bond yields actually being able to decline in that scenario? And more importantly, do you need bond yields to decline to get to your price target on the S&P?
Yeah, I think to get to my price target, it'd be hard for it to happen without bonds declining. So I'd probably be wrong, but my sense is that a no landing can still, be the view of the day for a while, but that ultimately, even right here, you're moving the mortgage rates back up. So I think housing is gonna find friction there. Starting to get a spring bounce, but I think it runs into trouble real quick with higher mortgage rates. We forget gasoline prices have risen this year, 50, 60 cents a gallon. And I still argue there's a have and a have-not economy. There's still plenty of money swishing around from the 5 trillion that was pumped in back in 2020, 21. But 80% or 70, 80% of the consumers are struggling to get by, and so you do have, obviously, those that have plenty of money. The wealth is just growing, and they benefited from tremendous home price rises the last couple of years, last few years. It benefited from the market here in the last year. So those guys are fine, but below that are a lot of people. You hear anecdotally, certainly, a lot of people using credit cards to buy groceries, that are, saying, I have to kind of take from Peter to pay Paul, and that things are not great. So I think under the surface, there's a lot of fragility. So it can look okay for a while here, but I don't think it's sustainable.
Gotcha. So that lack of sustainability, if you will, in the consumer's ability to propel the business cycle forward, you're not concerned about that potentially causing a business cycle downturn in a way that would actually prevent stocks from continuing to accelerate. You're effectively saying we're heading into like a soft landing, which is the perfect sweet spot of below trend growth, inflation continuing to come down, and ultimately the Fed policy and Treasury policy remaining pretty easy. Is that your central base case?
Well, that's basically what I think is going to be the narrative for the next 3 to 6 months.
Yeah.
It may not last 6 months. My macro view is that we're heading for a global bust, and I define a bust as something worse than a recession, but that happens at the speed of a recession. So it's not quite a depression. And as I say, 2008-9 was close to a bust, but we were pulled back from the cliff when the commercial paper market froze up, and the policymakers responded quickly enough and saved GE, etc. If that had not happened, if they had not acted quickly, I think we would have seen the bust then. And that's the difference between 2008-9 and what I think is coming here, is that we don't get pulled back from the cliff for a number of reasons. One being, that you've got a central bank mentality out there that says, we're not going to do that again. So just when they need to do something, they're going to be cautious. They're going to say, we're not going to pump this thing up again. And again, this is a global bust, so it's not just the U.S. In fact, our banks are in better shape than the rest of the world's banks typically. So because of what happened in 2008-9. So I think, some of the triggers, some of the catalysts could come from overseas, particularly Europe, maybe China, we don't know. Maybe Japan. Japan's a wild card out there. So my concern is that we have policymakers still focused fighting the last war, and they've been, as is typical, Wall Street's lecturing them, and they're listening to Wall Street. In 2008, we had Paulson listening to Wall Street, and instead of bailing out Lehman, he listened to them say, "Don't do another Bear Stearns. It's moral hazard." And I think that's basically why we had the financial crisis we had in 2008, is because Wall Street was giving him a lecture and he listened to it.
Oh yeah. So let me try to summarize your views to make sure that myself and the audience is on the same page. So you see over the next, let's call it 3, and correct me where I'm wrong, please. If you see over the next 3 to 6 months, you see opportunity for a melt up as a high probability outcome. And then beyond that, we see a bust. Can you unpack what's sort of driving the bust theme and if that timing is right?
Yeah, I use kind of, my shorthand is that it's massive leverage, as you know, 320 trillion in global leverage out there, global debt, plus quadrillions in notional value derivatives, which is leverage on the markets. So you got leverage at levels we've never seen before in history. You combine that with what happened in the pandemic, which I think under the surface has added a lot of fragility to the system. So yes, we've had what looks like a rapid recovery from the disaster in second quarter of 2020, but there's a lot of things that didn't come back from that. Certainly a lot of small businesses went under. There's a lot of people just trying to get from here to there. So I think there is under the surface fragility. And then you combine those things with what I think will be a big historic policy error on the part of the central banks, not just the Fed, but central banks, where again, I think they're going to be slow to respond when they need to respond. I think this thing we're going to find, as the saying goes, to paraphrase, things can look fine and move along and seem like you have everything under control, and then the shit hits the fan in a hurry. So I think they're just not. I don't have confidence that we have central banks, particularly in the mindset they're in after 2008-9 and all the criticism since. They're not in a mindset to be able to redo that again. They will do it. As I say, it's inevitable. We will see massive liquidity pumped into the system. I just think the timing is going to be slow because they're going to be worrying about yesterday's war.
Oh, it's interesting. Yeah, I think a lot of folks would sort of, I think a lot of folks would be inclined to take the other side of that trade. And the reason why is it seems, at least from my perspective, calling Vito slide 62 up here, just isolating the central bank is one factor. We can talk about the fiscal authority and another secondarily. It seems like every time we've had a sniffle in asset markets or the economy, the rate at which the Federal Reserve responds accelerates. In this chart, we just show bank reserves to nominal GDP. Bank reserves divided by several factors of commercial bank assets, liabilities, and bank deposits in panels 2, 3, and 4. But just focusing on bank reserves to nominal GDP, seems like we're making higher lows and higher highs at every cycle. And so that's just sort of one side of the argument. The other side of the argument is that we're in this fourth turning, and historically we've seen dramatic explosions in sovereign debt and deficits throughout each fourth turning, at least as many as we got data going back several hundred years. So the other side of that view is that the responses are getting bigger and bigger every time we have a problem. You're effectively arguing, yes, they're going to do that, but they're going to take their time doing that. What's going to cause them to be slower to respond than they were, I guess, say during COVID, for example?
Yeah, it's really not so much that they're taking a lot of time. It's that because of this leverage and because of the fragility and because of the state of the financial system, that it happens faster than they can respond. So it's about right size policy. So let's say we start seeing problems. They're going to look and say, we got to do something. We're going to put a couple trillion. We're not going to do 5 trillion again. That was crazy, but we're going to do a couple trillion. And they look and it's not enough. And they're my view is that the bust will require, just from the Fed and proportionally from other central banks, something like 20 trillion in new money in QE. So, wow. So it's just that we've never been here before. They're thinking they don't want to do as much as they've done before, and they're going to have to do many times more. That's really what it is. It's not so much that they're dragging their feet for months and months and months. It's that they're going to be doing it incrementally, thinking they're doing a lot, but the unwind is so great that it's not nearly fast enough.
Oh, I like this. Well, this is an excellent thesis, my friend. I will definitely have you back on the program to sort of, get some mile markers along the way. If you don't mind, we'll turn it over to the queue for some questions here. We got our first question from Brian. How you doing, Brian? Says sentiment is something you obviously pay attention to, Dave. That brings the AAI bulls bear indicator in mind. Are there other sentiment indicators that you like and pay attention to?
Yeah, I kind of look at it in a broader sense. You can look at, obviously, the Bank of America portfolio manager survey. You can look at some of the various institutional trader surveys. But I think you can look at what Darius showed on the chart before. I think he captured it better than a lot of those surveys. I think we make a mistake trying to turn it into a science and say, well, the AAI numbers are up this week or they're down this. It's not so much that, because you are in that kind of meat of the rally where you're not going to go back. I'm not looking for big sold out sentiment. That happened at the bottom, both the bottom in October 22 and the bottom in 23. So it's not so much that. It's really kind of measuring more from behavior, what you see on Twitter, what you see in terms of CNBC and elsewhere. you can get a sense that there's still an awful lot of skepticism in this market, and that's what you want. You just want to make sure that you've got a wall of worry that can continue to fuel the upside.
100%, my friend. I couldn't agree more in terms of monitoring sentiment. I don't think you can turn it into a scientific formulaic outcome, because we don't actually have real trustworthy positioning data for all market participants. What we have are different time series and different avenues to get information from that are incomplete. But if you're monitoring them on a systematic basis, you can spot some critical inflections in that incomplete data, and that's what we're trying to do for our clientele here at 42 Macro. The second question was specifically about what goes into our U.S. equities positioning signal here. So taking it back to slide 22, Colin. So in terms of how we aggregate non-commercial net length divided by total open interest in the combined futures and options markets, we do this for the U.S. equities. So that's all the equity instruments that the CFTC keeps track of. We do this for U.S. Treasuries across the curve. We do this for U.S. dollar for all the major currencies and gold versus the dollar. And then we do this for all the 19 components of the CRB index. And what we're trying to do, again, we're not trying to say, hey, it's short, it's long, or it's at this threshold, or it's that threshold. What we're trying to do is understand, okay, at these historical tops and bottoms in the asset markets, where are these positioning indicators? If we can find a position indicator that is consistent with a peak or consistent with the bottom, that'll give us a reasonable degree of confidence, particularly if we're seeing it across the entire table, that this is a potential inflection point in asset markets. Right now, as I said earlier, the key takeaway right now is that the shorter term, more tactical sentiment indicators, the more survey-based sentiment indicators, are the ones that are more correlated to systematic investor positioning, are suggestive that, okay, we probably are in the middle of a correction here. But the longer term sentiment indicators, I think the ones that you're probably more focused on when you're saying S&P 7,000, are suggesting there's ample upside risk in asset markets in terms of the wall of worry. And we definitely agree with that view. And that's one of the key takeaways from this analysis.
Yep.
Absolutely. So, kind of drawn to a close here. So, I do want to, again, I can't get, but 7,000 is I don't want to say a crazy number, but it's definitely, I don't want to hold your feet to the fire in terms of just getting to that number, because I think that'd be a fool's exercise. But I do want to sort of kind of think about what you're looking for between now and, let's call it 3 to 6 months from now, or however long it takes to get there. What are you looking for to confirm or disconfirm that view?
Yeah, like I said, I look a lot at cross markets, and if you look at some of the charts, and I probably am different from some people out there in that I like the longer the chart, the better.
Agreed.
I think sometimes people are caught up in looking at 6 month or 1 year charts, and they miss the bigger picture. Take a 5-year chart or even a 20-year chart of copper, or the copper producers. I mean, there's a beautiful picture there that says they're going a lot higher. I've got I just put out a target in my last letter on COPEX, the copper producers index ETF, and I think we'll go to 75. So, which it's down around low 40s. So, when I see those kind of things, that tells me there's legs to this thing, that the economy is not about to roll over and fall apart, and the dollar's not about to head off into the stratosphere. Those things, those kind of cross market indicators for me give me some of the confidence I have. And I'd say the same thing. Look at steel. Look at financials. The financial sector looks really strong here. I can't name names, but there are, I'll say a certain retail broker that I think could double from here. So, I mean, those things are telling me that this market has legs. That's what I mean by saying, if I can get confirmation from, not just a few charts, but a lot of cross market stuff, it just gives me more conviction. And I think there's a lot there.
Oh, I agree. We definitely agree. I mean, if you think about this from the perspective of getting confirmation fundamentally, we have sort of two themes right now that are, directionally bullish from the perspective of global assets, and particularly from the perspective of global commodities, which, is an asset class that has been largely left for dead for a lot of investors. Colin, if you throw the slides back up on the screen, one of those themes, so we authored the China front-loading stimulus theme back in December. Our view on that was that the best way to play that would be long commodities, and we're starting to see that. We've already seen a lot of it take place, but I think there's a lot more to go in terms of the broadening out of participation within the equity market towards cyclicals, as well as the absolute returns that we're seeing in commodity markets. Number two, the second theme that we authored in January was green shoots globally. Our models are starting to pick up on economic stabilization in a lot of these major economies in the world, places like Europe and China that have been, showing, persistent decelerations. Now, when you look and refresh the model, every major economy in the world has a composite PMI reading that's trending higher right now. And I'm not sure that a lot of investors realize that, but that's obviously a very bullish leading indicator for a lot of what's likely to occur over the next 3 to 6 months from an economic standpoint globally, which is very obviously bullish for commodities and cyclicals. And one final chart I'll show before I shut up here. This is one of my favorite charts that I've done in the last few months, which is if you look at the ISM manufacturing survey. So there's a lot of data points that come within each of the manufacturing PMI reports and the service PMI reports, but one of those time series is the number of industries reporting growth. And that number bottomed in December, I want to say 1 or 0. And historically speaking, when you go back and you look at the bottoms in this chart, going back to 2001, 2008, there's a bottom in 2012, bottom in 2015, bottom in 2020, and you go back and you sequence the bottom of those charts relative to S&P returns on a 1-year forward basis. The median return of the S&P from the bottom of this chart is plus 28% with a percent positive ratio of plus 80. So you want to haircut that, you're talking about a 28, 22, 23% return on the stock market based purely just on this particular analysis. But what it's telling investors, which is I think you're trying to get at in terms of what you're seeing with your screens, is that the broadening out of the market into cyclicals, into commodities, is being driven fundamentally both domestically and globally. And not enough investors are paying attention to this kind of stuff, the bottom of the global industrial cycle. It's a lot more sexy to talk about commercial real estate collapse or recession this and that than this, but the data is just telling you that we're moving in the wrong direction for those themes.
And by the way, I said before that once you get up to the top, it's going to be a compelling story that says this cycle has legs, or that whatever's going on here has legs. And I think that's the story that's going to be there. Is that it looks, when you look at some of these things like this chart, it looks like the beginning of a cycle. And you're seeing that as kind of the stock sectors are rolling through. Financials are starting to act better, and now you're starting to see. I mean, people talk about the Magnificent Seven and how narrow it's been. I've been fighting this argument for months. I said, take a look at the XLI, take a look at Caterpillar, take a look at PACCAR, take a look at Eaton. Take a look at Ingersoll Rand or any of the industrials. If you think this thing is a narrow market without anything participating but those 7 stocks, you're missing something. So I do think it's easy for people to buy into these narratives that get pushed on CNBC or wherever. They need to understand that a lot of those things you need to do your homework because they are not accurate. And I would argue what I'm also seeing is that the Russell is about to turn up. Now, obviously today wouldn't tell you that story, but I see signs that you're going to see the Russell outperform the NASDAQ, outperform the S&P, and outperform the Dow by quite a bit here in the next 3 to 6 months. And again, typically that happens when you're looking at a recovering economy or an economy that's getting stronger, not weaker. So I think all those things kind of at least give me some confidence that this thing has legs.
I agree. I appreciate you, David. Man, this has been awesome. I appreciate your wisdom and your insights. Love the way you think about markets, both from the perspective of fundamental investing, but also from the perspective of the behavioral side of it, which is the contrarian thought process. Before I let you go, my friend, my favorite question that I ask everyone who's on our program is, what is one risk management sort of tidbit or mantra that you live by today that you wish you knew at the beginning of your career?
Yeah, I think it is that. Yeah, for me, I mean, I'm somebody that needs to be aware of this. Is that if you are somebody that is not afraid to walk outside the crowd, and also somebody that invests by conviction, just know you can be wrong because it can be punishing if you're wrong. It's one thing to be diversified and have a little conviction that's outside the crowd, but when you're very contrary and you also have that conviction, just know there's there's no guarantees in this business.
Of course, absolutely. Well, I appreciate you, David, man. Thanks again for making time. We'll definitely have you back on the program in the future to kind of unpack how the evolution of these themes. And for the audience next month, we'll catch you back here next month. We have our friend Chris Berg joining from Abernathy Holdings. That's going to talk to us about the real estate market. So that's going to be an exciting update there. So I appreciate everyone for joining. We'll catch you back here next time. Thanks, David.
Yeah, thanks, Darius. Really enjoyed it.
Appreciate you, brother.